to show you is this very specific pattern. We'll take a break in about 10 minutes. You look at a chart, these are bars, by the way. You look at a chart like this, and the bars do this. Something similar to this, okay? Now, in the pattern that I want to show you today, what we do is call this a narrow sideways channel. Narrow sideways channel. Now, a narrow sideways channel is that, and by the way, this is an art. It's not an exact science, it's an art. So you engineers and scientists are going to have a hell of a time with this, okay? Because it's an art. You've got to train your eyes to look at this. You can see that there's an upper barrier and a lower barrier, okay? And what we're looking for is, we know that this cannot stay in this channel forever. Sooner or later, it's going to come out of there. Either on the upside, it's going to break out on the upside, or it's going to break out on the downside, one or the other, all right? As soon as it breaks above the channel, we would buy right here. As soon as it breaks above the channel, here's where you buy. If it breaks below the channel, you sell short to make money on the downside. And I'm going to show you how to do that after a while. So either way, we don't really care where it breaks. We don't care which direction the markets are going. We just want to know which direction so we can make money. All right? So you want to be able to predict to a high degree of accuracy where the markets are most likely going to go. All right? And if you can predict to a high degree of accuracy where the markets are going to go, you're going to make money. You're going to make money. So here's what we want to do. We find a channel. We look and see and wait to see if there's a breakout above or below, and that's our entry point. The minute it breaks out, yes, ma'am?
How is this different than like the Bollinger Bands?
Well, Bollinger Bands, I mean, you can use those. However, you know what? Those have more momentum in them as well. So this is a little bit more simplified form of looking at this, okay? And again, you're going to train your eyes to look at this, and it's a very simple way to look at this. By the way, I had a couple, they're actually billionaires out of Arkansas, and they're one of my clients. I do leadership development for this company, and I do all kinds of things. And the owner of this company and his wife decided that they want to go do a one-day workshop with Bill O'Neill, who's the publisher of Investors Business Daily. His one-day workshop cost $5,000. His two-day workshop cost $10,000. Okay, and they were in New Orleans, and they invited me to dinner in New Orleans, and they asked me to come up to their hotel room, and they said, Roy, we've taken Bill O'Neill's classes. They've done the one-day, the two-day, the three-day, and I sat there and I told them. They said, we want to show you on our computer what we're looking at, and I said, you know what? You're not going to be doing this program within 6 months. You will no longer be doing this program, okay? And they said, but Roy, we paid all this money. I said, I don't care. You're not going to be doing this program anymore. And I said, and you know why you will not do it? It's too complicated. It's too complicated. You've got to do too much analysis. You've got to figure too many things out. It's too complicated. So the rule of thumb is, and by the way, 6 months later, guess what? They came to me and said, we're no longer doing it. So they said, okay, we're ready to do yours. All right? So you understand, if it's complicated, you won't do it. You've got to simplify this as simple as you can, so that it's very simple, that anybody can do it. Just looking at it can say, I see that, and now I'm willing to do that. Okay? I'm willing to pull the trigger. By the way, everybody wants, you know what everybody's really looking for is the computer software program that tells you when to get in and when to get out. The green light comes on, and you buy. And the red light comes on and you sell. And everybody wants this, you know. The up arrow comes up, you buy. The down arrow comes up, you sell. I'm going to tell you right now, none of them work. None of them work. Now, I'll guarantee you, several of you are going to walk out of this class today and go buy some $10,000 or $15,000 piece of software. Okay? Because somebody's going to convince you that this one does work. Okay? None of them work, folks. Think about it for a second, folks. If they worked, how many people would be doing them?
Everybody.
Everybody would be doing it, and everybody would be making money. So they don't work, folks. They do not work. When you're buying a software program to predict the market, you're buying a mathematical algorithm. It's based on mathematics. The market is not driven by mathematics. What is it driven by? Emotions. Emotions is what drives the markets, okay? Emotions. See? Let me give you a classic point. Intel's one of my clients, all right? Intel was trading 2001, a little over $100 a share. Over 100, 2001. So Intel says, you know what? They knew the market was getting ready to go soft, so you know what they started doing? Selling off unprofitable plants, getting rid of their debt, having layoffs, getting lean and mean, knowing that the market might get soft. They were starting to get, you know, real lean and mean. And guess what? By getting rid of their debt, unprofitable plants, and getting, you know, less people, getting more out of, one of the reasons they hired me is how do we get more out of our people, okay? All of that was working, all right? And you know where Intel stock went to? $11 a share, folks. All right, now, I want to ask you a question. What's the difference between Intel at 100 and Intel at 11? But before you answer the question, at 11, because they had gotten rid of all of their unproductive plants, reduced debt and all those things, at 11, they're making more money. They're more financially sound at $11. So my question to you is, why is it trading at 11 when it's better than when it was at 100? Why?
Emotions.
Because that's what somebody's willing to pay you for it today. See, back in 2000, that's what they were willing to pay you. Yes. So somebody's psychological and emotional state says, I'll pay you 100 for it. But today, I don't care how good it is, I'm only going to pay you 11 for it. Doesn't matter how good the company is, doesn't matter how great they are, you're still going to lose money. No matter how great that company is.
Okay,
Because,
no question about that. Because, so, percent of the stocks traded in retail, you know, by people like us, not funds, they're like, what, 17, 20%, it's minor. So most of the stock are traded by, you know, big guys that actually know stuff. So if I'm one of them, I'm really working on that. If I know this company is going to be more profitable in the future, it should go up, right? So
should.
No, but I'm saying if they, because it doesn't matter what, you know, like common folks really buy, I guess. I don't know how to say it, but isn't this whole driven by the big funds that buy the stocks?
Well, most of it is, yes. We call them the elephants.
Yeah.
So the elephants drive the markets, okay? But the problem is the elephants get out here at 90 or 80, all right? And the common folks, what do? They ride all the way down. Folks, I was in Albuquerque, New Mexico. I had a lady come to me. She was a retired nurse. Well, she hadn't retired yet, registered nurse. Her husband had passed away, but before he passed away, he had 10,000 shares that he went out and bought her of Intel, not at 100. At that time, it had already come down to 88, okay? And he bought her 10,000 shares, 880,000. He says, honey, I know I'm going to die in a year. Here's your retirement. Here's what I'm going to leave you so that when I'm gone, this is what you're going to live off of. She came to me and I looked at that and she said, Roy, what should I do? Now, when she came to me, guess where Intel was trading? All right? She said, what should I do? I said, you know what? Knowing what I know, this is going to come down to at least, this was my prediction, it's going to come down to that, at least that much. I never suspected this. I said, but it will come down to 34. So what? You know what my advice was? So, you know what she told me? What would my husband think that he bought it here, 880,000, and I'm selling it for 660,000? She said, no, Roy, I'm going to wait until what? Until he comes back. That's what they all say. I'm going to wait till he comes back. Folks, it's still at 20-something, 22 today, 21.
Does it pay a dividend?
Yes, it pays a dividend, and that's a good thing, but still, how long are you going to wait to collect your dividend if you bought it at 88, you know? You're not going to ever make that up, especially if you're already at retirement age, okay? Folks, this is what's going to happen to everybody's retirement accounts, because they're going to sit there and watch it go all the way down. They're going to go down the tubes, okay? I had a lady come to me a couple of years ago. It was during Christmas, or no, right before Christmas. And she said, this was the first crash, so it was 2008. It was 2008, and she says, Roy, she'd gone to some of my workshop. She said, my parents are coming in from Chicago. They're retired, they're in their late 70s. She said they're from Schaumburg. I'm sure you know where Schaumburg is.
Yep, used to work there.
Okay, and I've been there many times over in Schaumburg, and they said, I want them to meet you because their retirement account, they're living off of that retirement account, and it is now down a little over 40%. Okay, so I'm very worried, and so are they. So she said, I want them to come in and talk to you about making that money back up. And I said, sure, we can make that up. Not a problem. We'll make that money up. So Christmas came and went, and I called her up and I said, Cindy, your parents never called me. Did they actually visit you for the Christmas holiday? She said, yeah, they were here. But you see, right before they came down, she said, I want you to send them an email of some of the things you've recommended here over the last couple of months and let them see how well you've done. And I love doing that. I'm going to show you some of the emails I've sent out. You can see how much money you make and could make. Okay? So I sent them an email, said, here's what I recommended this past week or last 2 weeks, and here's how much money you made. And they looked at that and they called her, called Cindy up and said, Cindy, we don't want to meet that guy. They said, why not? Well, we started looking at what he invests in, and he invests in things like oil and soybeans and gold, and he invests in all that high risk stuff. We're conservative investors. Folks, if you're down 40%, how in the world can you tell me you're conservative? Okay? You're nowhere near conservative. My account was up over 100% that year. How could you tell me you're conservative if you're down 40%? And by the way, if they're down 40%, you know what that tells me? Where's their stop? They don't have one. In other words, not only are they willing to watch it go down 40, how much more are they willing to watch it go down? All the way. All the way. They have no stop. Okay? So you're not a conservative investor, folks. You get that out of your mind right now. There ain't no conservative here. Okay? You find what works and start practicing that and prove to yourself that you can make money consistently. So there ain't no conservative. Yes, ma'am.
Okay, where do you go to find that pattern?
I'm going to show them to you here in just a minute. There's websites that you can go get those chart patterns.
But in a case like this, what eventually happens? You said the company got rid of all their debt and everything like that.
Yeah.
So who is making money in this deal? Will the company be making money still at the level?
Well, they're still making money. They're much more profitable, but it doesn't matter. What matters is the psychology and the emotions. Right now, at that point, somebody emotionally says, I only want to pay 11 for it. Now, they were willing to pay you 100 in 2000 because anything that had .com behind it, what did everybody think?
Making money.
Yeah, if you bought it and it's got .com, this thing's going to the moon, you see? So everybody bought it at that point. Well, it's not. So that's why you lose money, because the market's not driven by emotions. By logic and rationale and mathematics. It's driven by emotion. Fear, greed, love, hate, all of those things, okay? And the reason people do that, and folks, here's what I'm telling you. I have seen people buy a stock at 6, watch it go to 66, and back down to 3. And they hold it all the way. No plan, no strategy, and it's all emotion. You know what? When they saw it go from 6 to 66, you know what the emotion was now? What's the emotion?
It's going to go higher.
It's going to go higher, and I'm in love. All right? I'm in love. Because I've seen it go from 6 to 66, and I love it now. You know what? And I don't care how much you're in love with it, you still got to have a stop loss in place. And people do away with stop loss.